Welcome into This Week in Bitcoin, episode 93. My name is Chris LAS.com, JupiterBroadcasting.com. Well, here we go. Bitcoin's trading like a tech stock again. And the deflation narrative is back. We went from inflation and tariffs are going to wreck us to now deflation is back. And suddenly everyone from Wall Street wonks to perma-bulls, they're blaming, or depending on their view, crediting artificial intelligence. So if we are entering a grand deflationary phase, I think the real question is not what it does to prices, what does it do to Bitcoin? This really kicked into high gear with the release of OpenClaw a few weeks ago. OpenClaw has shook the market. They believe that AI and vibe coding is basically coming for every SaaS business out there. And the narrative that AI is a deflationary monster has caught fire. And I really mean from the old school, just really kind of geek, push the glasses up kind of analyst, the kind I like, to the perma-bulls that always think everything's great and they're going to make a ton of money. And when you see it kind of go across all forces like that, it becomes a narrative that really gets entrenched. Here's an example of the wonks.
AI was fuel for this bull market, so why is it suddenly driving the sell-off? AI euphoria has turned into AI anxiety, and billions have been wiped off global equity markets in a matter of weeks. From Silicon Valley to Europe's software champions, investors are suddenly questioning whether artificial intelligence is a gold mine or a wrecking ball. Harry Eastwood is investment director at Artemis Investment Management. So Harry, if fears of AI-driven displacement are only just beginning, how are you positioning right now, leaning in or pulling back?
Look, I think...
All right, really, you don't really care to hear what they have to say. Like I said, it's pretty wonky. Let's go over to the perma-bull side and kind of get a sense of what's going on over there. So for that, we go to your buddy, Cathie Wood. And if Cathie Wood's talking about a narrative, it's gone mainstream.
Trueflation is down to 0.8%. And so it too was stuck in that 2 to 3% range. It is resolving to the downside. And I think it's going to go negative. When I see Pepsi cutting the price of potato chips and Doritos by 15%, I take note. And when I hear Coke saying, yeah, it seems like there's a bit of a backlash against price increases, I take note. Today, the existing home price inflation rate dropped to 0.9% on a year-over-year basis. And we think that's going to go negative. New home prices are already falling on a year-over-year basis. Gasoline prices falling. So, and then the good deflation is associated with technologically enabled innovation. And, the AI boom is massively deflationary. The AI training costs are dropping 75% per year. AI inference costs, so what it costs when you query ChatGPT or Grok, what it costs to answer that's dropping 85 to, if you believe DeepSeek, 98% per year. And I think the productivity gains that we are seeing accrue to enterprises, that is going to turn around in a number of ways. One of them could be price declines. So many people think, these corporations are going to simply increase their margins. Well, China is exporting deflation. I know with tariffs, we're countering it, but isn't it interesting that our inflation rate did not accelerate with tariffs? It remained stuck. I think we're going to see a lot of price declines in the future.
I mean, it could be. I also tend to follow Trueflation, and they do show that inflation is better than the official numbers, which is odd. But I'm not so sure we can attribute the price reductions and inflation going down to the AI boom or AI productivity like she seems to be doing. Now, I will grant she is forecasting future productivity, but the implication is that we're already seeing the AI boom, and that's why the stock market's reacting. That's why investors are reacting. I'm not sure I buy that. I think it's just a lot simpler than that. Oil is cheap again, my friends. Simple as that. Oil is cheap again. Crude oil is down to around $65 a barrel. That's about a 13% drop from a year ago. Natural gas, also cheaper. Futures falling roughly 11 to 28% depending on when you look over the last 12 months. Energy is cheaper. And I think that probably explains more why the price of Doritos and Coca-Cola might go down a little bit than AI does, at least. Now, I don't know if lower energy prices really set off all the money printing that's coming, but that's a different discussion. But let's just go with a moment and assume that the wonks and the bulls are correct and that AI is indeed going to be a very large deflationary force. It does seem at least possible if agents get a lot of functionality and have a lot of their own autonomy, they could do a lot of work that would otherwise take a human. So perhaps we will see a productivity boom there. And if that does happen, you would perhaps see a prolonged productivity boom as people begin to learn and integrate these different agent skills and whatever. We're just going with the narrative for a moment. So if it's a long, prolonged transition, sort of, echoes of a fourth turning kind of thing, how does that prolonged deflationary cycle impact Bitcoin, which everybody always says is an inflation hedge?
Bitcoin is a hedge against inflation and deflation because the chaotic part of this is, and it's ripping through the markets now. A lot of traditional industries and companies, being brought, the whole SaaS space, the disaster, as they're calling it. We think there is merit to that particular one, but I think you're going to see disruption all over the place because the 5 innovation platforms that I mentioned are going to disrupt the existing world order. And what does that mean? If these technologies are so deflationary, it's going to be tough for the traditional world that's gotten used to sort of the 2 to 3% inflation to adjust. They'll have to embrace some of these technologies faster than expected. So the idea of counterparty risk, I think, is beginning to surface. We've seen it with First Brands. We've seen, private equity, private credit especially is where there have been a lot of excesses. SaaS, they are too exposed to that. Are we going to see counterparty risk manifest more broadly? If so, Bitcoin, it doesn't have that problem. And so it is a good hedge against deflation as well as inflation.
While I agree with her, I think what she's actually suggesting there, I mean, I agree with her that, about the sovereign risk aspect, but I think what she's suggesting there is that the AI disruption is going to be so massive, it's going to be such a tidal wave of change that the standard investments will start to have counterparty risk that people didn't consider. And when the market recognizes that on a dime, they're going to start buying up Bitcoin because it doesn't have counterparty risk. It's one of its best properties, you might say. Maybe Kathy's right. I tend to think these investor influencer types get a little excited. They get a little too ahead of themselves a little too soon. And we start spiraling into all kinds of fourth turning talk, and everyone starts losing their jobs, and robots are building everything, and AI is going to do all the management and all of that, right? I think if we use history as our teacher, the reality always is somewhere in the middle. And Lynn Alden had a great chat with the Bankless guys, actually, really recently. And Lynn, I think, has a real practical view on all of this. And she sets up where she thinks this is going and what she considers what really is a fourth turning and her observations in there.
But the parts that I find the most interesting are that historically the kind of the sovereign long-term debt cycles match up with the fourth turnings, which I don't think is an accident because kind of part of going through fourth turning is having a sovereign debt issue. And these things they have cause and effect. Like it's not like these things randomly pop up every few decades. It's that these things kind of build and they can only kind of go on so long. So the economic cycle, the debt cycle, is that you have kind of structurally falling interest rates. You have rising debt as a percentage of GDP. And for a while, that's both private and public debt. So every time there's a crisis, they cut interest rates. They try to restart the debt engine, the fractional reserve bank lending engine, the sovereign debt engine. And you'll get these little periods of deleveraging, but you never deleverage back down to the earlier part of like that particular kind of 5 or 10 year cycle. And you start building up from there. And when you string enough of those together, you get to very high debt levels and you get interest rates all the way to zero. And then you have basically maximum fractional reserve in the system. And what happened both in the 30s, this last time that happened, as well as the 2008 crises, those were kind of the peaks of the private debt cycle bubbles. And what happens when you get private debt maxed out as a percentage of GDP, you can't really cut interest rates meaningfully lower. That's when they generally shift toward printing money and then gradually shifting the debt from the private sector more toward the public sector. So that happened throughout the later 30s and into the 40s. Obviously, there are other factors going on, but they were interlinked. And then we've seen that over the course of the 2010s and here into the 2020s, that more of that shift from where we're not as leveraged in the private sector as we were in the eve of the global financial crisis in kind of the US and many developed countries, but that's been put toward the sovereign. And when it's on the sovereign level, it can't really go anywhere other than currency devaluation, because most sovereigns, at least the ones that have their own currency, will rarely ever default nominally. So they'll default through purchasing power, debasement, sometimes trimming prior guarantees about retirement or things like that. They'll make a series of kind of smaller defaults, more invisible defaults to deal with that. And that's kind of the stage we're in now.
Yeah, that's where we're at now. And so even if AI is a deflationary force, there are these larger historical macro forces already in play. And so it means Bitcoin's going to be in this weird spot. And so will the US dollar. And ultimately, I think it's good for Bitcoin, but it's bad for the dollar. And you have to imagine all this uncertainty only leads to destabilizing the dollar as a reserve currency. And we end up in what people call a multipolar world, where instead of having one giant superpower with one giant financial market, you've got a couple of islands, maybe more, around the world that concentrate power.
I do think the more multipolar side wins, which is more of the China side, like the more that they get some degree of kind of dollar independence and neutral reserve assets like gold get elevated. But that's not even necessarily bad for the U.S. It goes back to my prior point around Triffin's dilemma and things like that. It depends how the U.S. plays its cards while this is happening. So, and I've read a couple pieces on this. One was back in 2020 when I talked about the rise of this kind of multipolar world happening. And then, of course, I featured it in Broken Money in 2023, this kind of shift toward a more multipolar world. And, I can't say exactly what's going to happen, but there's kind of a couple options you can lay out. So one kind of point there is that there's really no currency in the world, including the dollar, like let's say no fiat currency in the world, including the dollar, that's big enough to serve the whole world anymore. So when this dollar system was established, I mean, the U.S. was over 40% of global GDP. We were the only thing standing after World War II, and we had we had all the gold, we had all the manufacturing, we had 40% of global GDP. We could run the ledger. Over decades, Triffin dilemma has poisoned that well to some degree. In addition, China, India, Europe, they've kind of recovered from the whole period of colonialism that happened, the whole period of total war that happened. We've kind of gotten closer to historical GDP ratios where these big population centers are rising back to their kind of normal place as pretty big economic powers. And there's really just no currency block big enough to solve the whole world without Triffin dilemma being a really big deal. So even China's not big enough. The US isn't really big enough. And so that means you generally need one of two things. Either you need diversification. So maybe you have two really big hubs. You have the US and China has two really big hubs. Maybe Europe is kind of its own third smaller hub. And so no ledger is trying to serve the whole world. The challenge there is that money has network effects. It tries to trend toward one, but liquidity begets more liquidity. And so, it puts pressure on that diversified model to some degree. And then the other option, the part that kind of alleviates that, is neutral reserve assets. So you can have a diversifying of the ledgers, but then also these neutral things that bridge them. Gold being the incumbent neutral reserve assets, the obvious first choice, is the one that central banks already hold. It's the one that almost everybody in the world can understand to some degree. It's got this multi-thousand-year track record, with the main caveat being that it's really slow and expensive to audit. So it's great as savings. It's not great as settlement. Like when Germany wanted to repatriate part of its gold, it took years. And they finished ahead of schedule, and it took years. It just took fewer years than they thought. And that's, I mean, whereas like, a Bitcoin transaction, you get 6 confirmations in an hour on average. And so, it's just like a different world. Now, Bitcoin is, I mean, it's a settlement rails and it's a store of value. It's got 17 years of track record now, but it's, we're talking, depending on if you're in a bull or bear market at the moment, it's a $1 to $2 trillion asset. So it's still small on the network effect scope. It's still, even though it's got reasonable liquidity, it's still pretty small on the liquidity spectrum. And then sometimes, there are people that just don't understand it. There are people that are say, well, I mean, is it prone to risk XYZ, let's say quantum, for example, in a 5, 10, 15, 20-year time horizon, which sovereigns are going to think in. So I think that's a rising contender, but I think this is a very long game. And it really not until, Bitcoin has like an extra zero on it, would it, like its market cap, would it be like a contender at the scales of dollars and Chinese currency and gold?
All right, so that was your macro protein. Now it's time for some Bitcoin carbs. I want to talk about BIP 110 for a bit. You guys deserve it. I have been avoiding it on the show because I find the topic to be gross. And it's hard for me to cover it without that bias because as a longtime Bitcoiner, BIP 110 is frustrating to me. But I'll try to get through this a little bit and I'll explain my thoughts here. But it really is probably the most important philosophical Bitcoin fight since the blocksize war. The supporters say it's going to protect Bitcoin, and critics say it changes fundamentally what Bitcoin is. Now, the person behind it, we don't exactly know. It's a pseudo-anonymous dev. We have some speculation as to who that might be. They kind of popped up a little while ago and, are pushing one of the most significant changes to Bitcoin in history. Now, early momentum for BIP 110 is really in the Bitcoin Knots community and those that run Bitcoin Knots. They call themselves, and this is the part I think that really gets to me, is Bitcoin as money advocates, or they'll label themselves as anti-spam advocates or hard money advocates, implying that the people that are against BIP 110 are spammers or don't want Bitcoin to be sound money. And critics like core dev Adam Back and others worry about a precedent that it sets, as do I. And it's a big deal. So here's where we're at in February of 2026. There's about 2 to 3% of the reachable nodes on the Bitcoin network that are signaling support for BIP 110. No major mining pools are on board, but there has been some miners that seem to be trying to figure it out. Now, what we are worried about at this point is, what BIP 110 is worried about at this point, is that Bitcoin is drifting away from being just sound money, and that it could be a data chain to store data, arbitrary data, inscriptions, filling up blocks, tokens for weird markets, arbitrary data, for storing JPEGs, things like that. They don't want Bitcoin to become permanent data storage for junk over time, or maybe even illicit material. What people that are against BIP 110 argue is that if you pay the fee, it's not necessarily spam, that there's a monetary system built in, and non-monetary uses still end up subsidizing security. Bitcoin's always been this way, and filtering at the protocol level allows for censorship. And once you start allowing for curation of block space, Bitcoin inherently becomes political. So what we're talking about with BIP 110 is a temporary consensus change limiting embedded data in transactions. It would cap output data at 34 bytes. Op return would get capped at 83 bytes, and this would go for a year, and it could be extendable. And that would definitely have a negative impact on ordinals and BRC20 tokens, and anybody that's kind of trying to put large data loads in there. I don't think it would have any significant impact today on the network if it were to be implemented. And this is, in part, why I think people are comfortable with it, is because if you were to implement that, it just kind of keeps Bitcoin as used as money for right now. And that's not so bad, right? But what happens after that year? What happens if there does need to be a fork? That's where things get really, really bad, really, really quickly, in my opinion, and why I have concern. So I grabbed some clips from the Plan B forum that just happened. These clips are about 9 days old. They were posted online about 9 days ago. This is the BIP 110 debate that was there. And we'll start with Bitcoin Mechanic, an individual that I've generally liked quite a bit, but I just don't agree on this particular issue. And he'll talk about why he's pro BIP 110. And I want you to pay attention to the language that's used here, because it's the type of language that if you don't understand the meaning and ramifications behind it, It sounds pretty effing reasonable. And I think it's why so many people that are just watching YouTubers talk about this are getting convinced it's a good idea.
Understood. Yeah, I think it's pretty simple, if I can put it in as simple terms as possible. I don't think anyone thinks that 1 megabyte op returns, which is what's always been possible with consensus, do anything for Bitcoin. I don't think anyone that's ever used it as money has used that. And effectively, it was just a mistake that was never really a thing that manifested because of a ubiquitous relay policy that capped it at 83 bytes, moved around a bit. You can sort of gloss over the implications of that and talk in theoretical terms as John does, but it's obviously misleading because the practical manifestation of having that filter in core for years meant that almost all op returns fit within this tiny limit, and that's perfectly observable in blockchain's history.
So they were okay with it if it fit within that tiny limit. You know, that wasn't ideal, obviously, he's saying, but we could live with that.
So core pumping up the limit opens us up to a thing that no one really wants in Bitcoin that's just there anyway, that was effectively, the implications of it were kept away by this filter.
So core increases the limit. We've covered that on the show. Now, what's interesting is the mechanic here is shifting into the theoretical after just criticizing somebody for talking in the theoretical. But we continue. So now the op return limit size has been increased. This is a problem.
And the whole ideology, the discussion around filters meant it had to go for posturing purposes, but no one is actually stoked, including even Tone in his presentation yesterday, about big op returns now being an easier thing to stick in the chain. So BIP 110 comes along and says, all right, well, op returns just aren't a good thing, especially when they're that big, because, contiguity, and I guess we'll get into that later. I know Giacomo doesn't particularly care about that. But the point is, massive op returns are not doing anything for Bitcoin as money. So limiting them a consensus basically puts us back where we were before, even though it's a different mechanism, because prior to this, it was a filter that kept them small. Now it will be consensus. But either way, there's no hodler in the world that's losing some aspect of Bitcoin by virtue of not having 1 megabyte op returns be possible anymore.
See, look, it's not a big deal. And it's only for a year, right? What could be so bad? We're just tweaking how we enforce it. It used to be enforced a different way. Now we're going to enforce it a new way. What's so bad? Well, here's Tone. He takes the other side of it, and he cuts really to the heart of the matter.
Main point of contention is that this soft fork, BIP 110, is incredibly dangerous. And one of the main reasons why most technical people, including the core developers of 2017 days, which we will all agree was higher quality batch of developers, were very concerned of using BIP 148 to get segued through a soft fork, because the ultimate consequences in the future will be that a small minority, a vocal minority, would be able to now push some kind of controversial change, as was just stated. Let's just do it now and then figure it out later. This reminds me of 2 weeks to flatten the curve. Who remembers that, right?
What he's referring to, and I didn't have this part in the clip, is mechanics suggest we should just do this. And we got a year and we'll figure it out. It'll be fine. What could be so bad?
Just 2 weeks to flatten the curve and we will figure it out later. And what happened for the next 2 to 3 years? So I think that this push for the user-activated soft fork is incredibly dangerous. It needs to be shut down as soon as possible. The sooner they turn it into a hard fork and get off the network, and they can claim for the rest of eternity, like Bcash and BSV, that they are the real Bitcoin because they know what is best. That is my main position, that the user-activated soft fork is the problem. And we can talk about what led to the soft fork. I didn't have a problem with the NOTS implementation, but look what it's turned into. And yes, I am critical of core development. That needs to be better, but this is not a solution. This is insanity.
And I think one of the things that leaves me unsettled about all of this is there's sort of this smug attitude that they don't need the majority. They only need a tiny minority of the network to pull this off, and they know it. And so they're not really too worried about reaching mass consensus. And Luke Dasher reveals how the BIP 110 folks are thinking about this.
That in this case, having a minority of users being able to change the protocol, even if the majority, defined in different ways, don't agree, is itself a dangerous precedent. Is that a good point?
That is Giacomo, and he's asking the question, to Luke, and I'll just back it up just a bit so you can hear the end of the question.
That in this case, having a minority of users being able to change the protocol, even if the majority, defined in different ways, don't agree, is itself a dangerous precedent. Is that a good point?
No. The minority can change the protocol as long as the majority is not actively in opposition to that change. If the majority opposes that change, the minority cannot change the protocol.
In other words, if they can do this, and most people that are running nodes and most people that are using the Bitcoin network are essentially apathetic to this, they don't care, then the Knots folks can get away with this. They can actually pull it off. I'll let him continue and I won't interrupt, but that's what he's saying.
The minority can change the protocol as long as the majority is not actively in opposition to that change. If the majority opposes that change, the minority cannot change the protocol. It's only when the majority is indifferent or doesn't really care that the minority can successfully change the protocol.
And that's your current model of the community, is that even if the minority is going to push for that, majority, except for the literal attackers, will not really care and will just basically go with it, along with it inertially.
Right. If a sizable minority is pushing for a soft fork, the only way to reject that soft fork for the majority is to do a counter fork like Bcash did, where they reject the soft fork changes explicitly in the protocol.
Before moving to mechanics, don't think it's possible that the hash rate connected with this proposal is so low that even without an explicit rejection, you still remain waiting for blocks for a very long time? Do you think this is an implausible scenario?
So he's essentially saying, well, what if you don't get enough hash rate to participate? Aren't you just going to be on your own little island? Well, Luke's thought of that.
There is probably a minimum hash rate, maybe 10% of the network hash rate, that would have to support the soft fork. Without that, then the people that want this would have to do a hard fork.
Good thing Luke and Mechanic both run and operate ocean mining.
But that's not a realistic scenario. And in this case particularly, because Bitcoin is pretty much guaranteed to fail if we don't do this soft fork, it's even if there was a persistent chain split of some sort induced by the opposition, it's only a matter of time until the opposition's spam-friendly chain dies and the spam-hostile chain survives.
The opposition's spam-friendly chain. In other words, the Bitcoin chain you're currently using right now. Jesus. And he says later, like, somebody asked, well, what about the risk of this? You're talking about user-activated forks, and we could have all kinds of problems. And their answer is, well, the crisis is so existential. The threat is so existential. The crisis is so immediate that Bitcoin is dead if we don't make these changes, so we should make these changes. Well, okay, if that's true, let's look at the logic.
Stay a while and listen.
Because we have some data now. Op return increased the size limit with Core 30. Core 30's been out for a little bit. And so here's what we know now. Multi-op return spam, which is the one they're really worried about, nearly non-existent. Large op return payloads in the Bitcoin blockchain since this went live, statistical rounding error. In fact, the usage that does exist is still the old, smaller way, the one that Mechanic starts saying he was, not happy with, but could live with. That's actually the most widely used way to jam data into a Bitcoin transaction right now. And we all know that the fees have been low for a long time. Now, the real action is inscriptions. They use witness data, not op return. So you can have both things be true at the same time. Op return abuse is a statistical rounding error. It's negligible. It's hard to even measure. And there can be at times block space pressure from inscriptions. Two different things, both real, okay? It's not that bad. Only 61 multiple op return outputs were used since September of 2025. 61. Do you hear me? For large payloads and other concern, 0.0016% of transactions. The total since September of 2025 for all data on the blockchain is 474 megabytes. Okay? So this entire scary scenario that they are freaking everyone out about, that Matthew Kratter is scaring everybody on his YouTube channel, the Mechanic and Luke are going around saying Bitcoin is dead if they don't make these changes. Well, there you have it. 474 megabytes of data. That's it. 61 large op returns where they use multiple. There you have it. That's it. That's the spam scenario that we're willing to risk a soft fork over. You can see why I consider it just stupid. And the people spoke too. Core 30 was adopted very quickly. They didn't seem particularly concerned about this. So I'm not really sure, outside of Cratterstands, Mechanic, and Luke, and a few others, who's actually truly concerned about this. And when you put it all together, it looks like people appealing to emotion to get political control over Bitcoin, and also at the same time, they have Ocean as a pool play to help centralize mining. Even though they say it's not about centralization, you can't help but start to wonder when you put the entire picture together and you add knots into it, it actually starts to look like a hostile takeover of Bitcoin, which is what they're accusing the core devs of. But we have to remember, this is the current chain. Like, what they're talking about is they're talking about messing with your sats. They're talking about messing with your blockchain to fix a problem that doesn't even really exist. So I think the entire thing is absolutely ridiculous. I have more links, including from them, so, both sides, in the show notes if you'd like to read more on your own. But I have a question. Where do you stand on this BIP 110 stuff? Do you disagree with me? I'd like to hear your opinion. I really would. And if you do agree, has it changed your knots view? Do you not look at Bitcoin knots the same way anymore? I'd like to know if those things, either one of those things, are true for you. Boost in, support the show, and let me know, because I'd love to read those in episode 94. Well, a lot more show coming up, so support the show just by doing what you do. Stack them sats, and if you're going to do it on River, use the link in the show notes. In fact, I have links for all these in the show notes. River is one of the best ways in the States to stack sats. Now, if you're all about self-custody and you're in Canada or the US, the Bitcoin, automatic self-custody platform. You ready to spend some sats? You got them on Lightning. Go from sats to gift card in just seconds on the Bitcoin company. All they do is Bitcoin, and you can log in with your Lightning Network stuff. No, extra credentials, none of that stuff. Fold card, stack sats as you pay your bills. As you go about your day, passively stack sats. Fold card's a winner. Go check it out. Last but not least, if you're ready to get access to your Bitcoin liquidity, wouldn't it be great if you could time the bottom and take out a Bitcoin loan? Well, Salt Lending has great services and offers a couple of extra protection services against margin calls, which is always really nice. So those are some great ways, besides boosting and memberships, to support the show by doing what you do. All right, it is time for some boosts.
407 boosts to go.
And Murray Fio comes in with 33,333 sats. Moy says, maybe your best episode yet. I bet you that's not how you say your name, though. If this is your first best bear market, the key thing to distract yourself is listening to Bitcoin podcasts. It will reinforce why you're in this and will help pass the time until it turns up. Also, make sure to put on another drop in the bucket every time it dumps. Buy another stash right there. That's very true, is reminding yourself. It's like, you could say it's like, immersing yourself in cope. I actually think it's about reminding yourself of the fundamentals, right? Because so many times, always, the issue isn't within Bitcoin. It's externalized. So helping remember the fundamentals, why you're there, the thesis, it actually is useful in these times. That's a great boost. Thanks for being our baller. Appreciate you. PJ's here with a row of Mick ducks. Hey!
This old duck still got it.
Yeah, here he goes.
Things are looking up for old McDuck.
This low price is what we wanted during the last peak. Funny how everyone's memory is so short. Not that this community, though. We know better. This is our opportunity to stack and build for our future. Most of us don't have a fiat retirement plan and are too old or make too little to build one, but young enough to build a slow stack. So just stack sats. Amen to that, PJ. It's funny. I guess I had these because we had expectations, right? We had all these expectations, but you're right. It's like if this took, another 3 years, if this isn't going to what happens, but let's just say cumulatively over the next 5 years, we have 3 years of bad price action. Well, in 10 years, you're going to look back and be grateful. But right now, it doesn't feel as good. That's a really insightful one. Thank you, PJ. User 56, and if you want to boost in again with your full name, let me know. User 56 is here with 21,112 sats. Chris, I've looked forward to your show every week for the past year. I respect the hard work you put into it. Well, thank you, sir. Keeping the signal high and emotion low. I hope your content continues to turn new people to Bitcoin, Fountain, and the value for value structure. With that said, please accept my humble investment of 21,000 sats. Also, I know you talk about the Fold card and Bitcoin rewards. What are your thoughts on the Gemini card? Boost! Boost! I have the Gemini card. I have the older one, not their newer one, but it's essentially the same. I thought they were supposed to upgrade me in October, by the way, Winklevoss boys, but I got it a long time ago when it came out, and they would let you do any crypto. And I think for 10 minutes, I accidentally did have it on ETH. I think maybe that was the default. I don't remember. That lasted for 10 minutes. I'll tell you what I've used it for. Large repairs. Like I'm going to maybe pay off over like 2-3 months or sometimes longer, unfortunately. It's like might as well stack some sats. If I've got to fix the slide for $5,000 on my RV, I might as well get some sats for that. And several $100s at least, maybe over $1,000 of rewards, probably at this point. So I've liked it. If you don't pay it off, though, the interest rates can kill you these days. So you just got to watch for that. But you probably already know that, eh? Thank you for the boost. Boba's here with 21,000 sats.
21 gigawatts!
What do you think Jack means by the term home? What exactly is home in this case? Yeah, Bitcoin's coming home. I believe I saw the floor in real time at 60K during this last leg down. The bounce back looked almost like it was programmed. Remember, everyone set their auto buyback at 60K. Miners may need to brace themselves as the chart readers are touting a capital rotation event. And they think it's still going to go lower through Q3 and Q4. Interesting how people in the space were calling the 4-year cycle dead and never existed and expected things to go up against the 4-year cycle prediction. Well, I'm sitting here seeing things go down and down. Is it possible that 2025 was the up year, but the whales taking profits just masked the top? And how about 2026 and why we're down relative to 2025? Okay, I want to answer this now, but I want to see, I don't know if I saved this clip. I didn't. Okay. Well, I had a clip and I decided not to play it because I already played too much Lynn. But Lynn was in another interview this week where she kind of brought up a good point, something that I probably should have brought up on the show sooner because it's crossed my mind. The treasury companies really took some of the spotlight and the energy for retail. So I think when you combine treasury companies and whale selling, you create a sort of a self-fulfilling 4-year cycle in a way. And I do think that maybe some of Bitcoin's gains that we expected in 2025 went to digital asset companies that are essentially underwater now. It's like the new version of altcoins. Now I wish I would have brought that clip, but I do have one that will kind of answer a couple other more pieces towards the end of the show. So do stay tuned for that, Boba, and thank you for the boost. Kangaroo Paradox is back with 21,000 sats.
21 gigawatts!
Great episode and a great boost episode. What's all this noise around BIP 110? Well, I hope I gave you some idea. I hope I did at least. I know I could do it better, but I find it's a very frustrating thing for me to research because I don't know, be where I stand on it, I suppose. It's the one issue on the show I have a hard time not getting very worked up about. Everything else is pretty straightforward, but when you start talking about user soft forks for something that's just a non-issue by people that don't know what the hell they're talking about, I don't know, man. I don't know. I have a hard time, Obi. But thank you for the boost. Derivation Dingus is here with 21,000 sats.
21 gigawatts!
I don't love it, but I'm still sticking with it. I might be biased, considering I've Nixified nearly every device in the house. But I'll add a big old +1 to Nix Bitcoin. It's been rock solid for me. I deployed it on a NixOS container a couple of years ago, and I just did another major version update on it just a couple of nights ago. The update went super smooth, no issues. After a quick reboot, everything was back up, including the Lightning channel with your node. Nix Bitcoin is awesome. I think so too. The only reason I don't just say that's the only way to go is because there is a technical overhead to Nix. But I think if you are in a business, if you're going to run merchant shop, Perhaps if you're a podcaster with high volume or, humble high volume, nothing serious. I think you really should consider it because it's much more robust than any of the other systems. And I'll just leave it at that. I talk about Nix enough other places. Thanks, Derivation. I do appreciate the +1. It gave me a little bit of an excuse to talk about it again. I'm going to be honest with you. Hey, there's Gene Bean. 4,534 sats.
This is the way.
From what I've learned thus far, it feels to me like there are other things at play that generally line up on the 4-year intervals rather than Bitcoin itself having a 4-year cycle. Primarily, I think what you've laid out previously about liquidity market being the driver is really the key. Yeah, and I think too, like you have election cycles in there, which often bring with it Fed cutting cycles and all those kinds of things. I am of the camp that you're going to have a declining influence of the 4-year cycle. That the 4-year cycle mattered a lot more earlier on, especially when it was just Bitcoiners. But as you have all these other entities that are soaking up inventory, and the miners are making already less than the daily supply being bought often, I do think there could be some diminishing returns around the 4-year cycle. But, if everybody wants to F around and find out,
I am programmed in multiple techniques.
then we're going to find out.
The traders love the vol.
Gene says, I wonder if you and Wes could update us on the boost tooling to resolve Nostr addresses. I tend to boost the show from Fountain simply because it also posts in Nostr. Yeah, which also helps the show on the Fountain trending pages. I wonder if the tooling could also use Fountain includes boost to make that easier. That would be a truncated boost from here. Yeah, okay. So yes and no, Gene, because there's a lot in transition right now with the boosts and LNURL and metadata in particular. And I think a real telling thing will be which direction Podverse goes, which they're investigating it right now. I would have been happy if a year ago we all just would have gone all in on Nostr for the back end, and then we'd have it decentralized. Instead, we're going to go some sort of HTTP metadata server where you have to have a metadata server running on somebody's box, which is going to lead to centralization. And the best answer that the Podfather and Podsage have right now is to have everybody centralize on Strike and use some hack together third-party tool to go read the metadata off Strike. like that's the opposite direction we need to go, right? Yeah, let's go. I like Strike and I like Jack, but that's ridiculous. We can't all centralize around Strike. It's not even available everywhere. I can't even use Strike for some of those purposes in Washington State. So like we need something that is workable. And Mitch is looking into it. He's trying to figure it out right now because he's at that stage for the new Podverse development. And I had a phone call with him recently about it. And we haven't solved the LNURL metadata issue. And hopefully we will. Hodler comes in. Thank you, Gene, by the way. Hodler comes in with 4,747 sats. Greetings from Iceland. I completely agree. This is a great time to work hard and stack more sats. I think we just have to stay at these lower levels for a big chunk of the year. Just have that feeling. Oh, do you now? All right, Hodler. Yeah, no, I'm starting to feel that way more and more, too. Moonanite's here with 2,000 sats.
Well, let's hear it, good buddy.
+1 to ppq.ai. That is basically pay per query.ai, ppq.ai, and you can pay with Lightning. I use it a couple times a week. I love having access to the latest model without needing to spin up a single account. These creepy AI tech bros don't need to be keeping a profile of me. That's true. That is true. That is a nice advantage of it. I think you're onto something there. Thank you, Moonanite.
Make it so.
Ace Ackerman's back with a row of ducks. That's 2,222 sats. Well, 58K does seem like the bottom to me. I'm starting to agree with the idea that not only is the 4-year cycle dead, but it never really existed in the first place. Oh, now, Ace, I feel like that is a hot take, since we are currently, what some would argue, in a price decline that the 4-year cycle would have forecasted. So I think it's bold for you to come in and say 58K is the bottom when we're not even at 58K yet, and that the 4-year cycle is dead at the same time. And I like it because I'm feeling that vibe, but I want to know your logic. So, Ace, if you want to follow up, I would love to hear it. Tomato's here with a row of ducks. I don't see any reason why Bitcoin couldn't stay under the cost of mining for quite a while. The miners with reserves would just keep going, and the small ones, well, they wouldn't make it. But my prediction is that it doesn't stay below 60 for too long, exactly because this idea is widespread, and people will start buying again if it does. Tomato, that is some next level market reasoning right there. Once it becomes a narrative, you can trade it either way. And also, I think you are absolutely right one of the things that makes mining so brutal is you do have to sometimes, you have to just grin and bear it during a bear market. And the ones that can do that better and extend credit, et cetera, maybe, make a little more money off of AI, they're the ones that are going to survive. So how long do you think it goes tomorrow? You say you don't think it'll stay below 60 for long. What does that mean? Thank you for the boost. Kiwi Bitcoin, he's back, 6,789 sats. One plus, that's the phone. +1 for the ppq.ai site. This has been my go-to AI for about a year now. Oh, it's built by a Bitcoiner. You get a discount when you pay in sats, and you can pay over Lightning. There's zero KYC and the built-in privacy of Lightning. I use it with a VPN like Molvad, which I also pay for with sats, and offers pretty good privacy for general use. You can connect via a browser or with API keys. I use it for general topics or learning, not for anything private or sensitive. You can connect to all the latest models, and it's really great. Okay, what are you using it for exactly? You say learning and topics. I'm now discovering that you guys are using these high-end models for a while, and I'm wondering what you're doing. Part 2, I'd love to hear more about your node config on Bitcoin Core and what version you're using. I've been holding off on upgrading, and I'm still running 28, but 31 is coming out soon, so I think I need to upgrade to keep with the maintenance window. What configuration changes have you made to the defaults? Well, so I'm on 28 and 29. I know that's a cop-out, but I, like you, have been expecting and planning to just skip 30 and go to 31. And when I do that, I will try to document what I change. I'll probably do it at the NICS config level, but I think you could probably use that even without NICS because they're just config settings. And I will try to share that. I will share it publicly when I do that. And I think it'll be around the 31 release. I'll probably give it a beat. I generally wait, a week or so just to see if anything absolutely blows up, and then I start updating my nodes. So I will keep you posted on that, Kiwi. And this, by the way, is, I don't know if it's my recommendation, but it's my approach when there's ever a controversial release or a big point release with some new features. I wait. And with Bitcoin, you can do that. So why not take advantage of it? Unless there's something you really need. That's a great boost. Thank you, sir. Nakamoto6102 is here with 3,500 sats. Appreciate the value. Well, I appreciate you, Nakamoto. Thank you for the boost. Bobby Pin is here with 10,000 sats.
You make me want to be a better man.
I'd be willing to go to a Bitcoin meetup if it's relatively close. I'm going to a mining disrupt in Dallas, Fort Worth later this year. I would love to do that. I miss Fort Worth. I was down there quite a bit a few years ago and haven't been back since. But when I was working at Linux Academy, I was there quite a bit.
Oh, I'm in.
Yeah, it was great. I'd love to know how it goes. That'd be really neat. Thanks, Bobby Pin. If you remember, send us a report. Thank you, everybody who boosted the show. Those that came in below the 2,000 sat cutoff, I still got your boost. I still got them in the show notes, and I still really appreciate it. Also, I want to thank everybody who streamed sats. Wow, the sat streamers were really our baller booster this week. 90,421 sats from our sat streamers. Thank you, everybody who just streams those sats as you listen. When we combine it with our boosters, it's a pretty good episode. We stacked a grand total of 345,654 sats. There's no advertiser on this show. In fact, I was just approached by one this last week who had a pitch. And I said no, because we've been getting great boosts these last few weeks. It's a value for value show. There's a membership through Fountain and Jupiter.party. You can put your support on autopilot as well. Really appreciate it. Fountain makes it easy. AlbiHub makes it totally self-sovereign. And that's all over at fountain.fm, or go search for AlbiHub. And then get yourself a Podcasting 2.0 app. You get more features, the boost capabilities, all of that. Those are at newpodcastapps.com. All right, let's talk a little price action. Why? Why should we talk a little price action? Because the speculation as to why the price is down is quite funny. So we start with Fox Business, who's trying to wrap their head around it all.
Crypto this morning, which is once again lower. As you can see, Bitcoin down again, now below 68,000. That is down better than 25% over the last month, roughly 50% from the all-time highs, which was about 127,000. Bitcoin has had a rough going. Ethereum as well, down nearly 40%, weighed down by ETF outflows, softer institutional demand. Analysts say Bitcoin could fall to 50,000, warning a sharp V-shaped rebound is looking more unlikely. While others are arguing that digital assets close to hitting a price bottom.
What's going on here? What's going on? So they want to figure it out. So they bring on the world's premier, I guess, expert, Mr. Wonderful, clearly, right? Because he was buddies with Sam Bankman-Fried. So clearly, Kevin O'Leary is the one to go. Clearly, it's O'Leary. He comes on. And actually, at first, he's doing all right. But then just as he's wrapping it up, he tosses a turd in the punch bowl.
How do you think about Bitcoin fundamentally, technically, especially after a little bit of this washout we've seen?
Well, Bitcoin has had a major correction yet again, down 50%. This is not the first time this has occurred. Something else has occurred, though, underneath it that is quite a problem for the crypto market to resolve. Last October 20th, was the day when this stuff really melted. But
No, it was not October 20th.
Not just Bitcoin, everything.
Yeah.
Some of them down 80, 90%. The reason that occurred, in my opinion, is everybody in the institutional and sovereign wealth at that time saw that the Clarity Act, the Stability Act that made the first act, which was the Genius Act, the second part was going to come and make Bitcoin legal for them to own in an index. It didn't happen.
This is so dumb. This is so dumb. This is worse than I remember, actually, when I first heard, when I grabbed this clip. So first of all, it was October 10th, and it was because Binance's stablecoin depegged, and a bunch of market makers got washed out and completely drained liquidity from the crypto market and destroyed the plebs, and some of the crap coins are down like 80% as a result. It really had nothing to do with Clarity. Now, Clarity's been an ongoing price suppressant, but made Bitcoin legal for them to own? What the hell is he talking about? Like, what does he think BlackRock and Saylor and everybody's been doing? What are they talking about? Like, he's just saying stuff.
The second part was going to come and make Bitcoin legal for them to own in an index.
What?
It didn't happen. So they were doing a lot of analysis. This is quite shocking. It turns out...
Oh, it's shocking. So they were getting all in. You see, these dumb, stupid institutions spent 5 years researching Bitcoin and buying just at perfectly timed moments when the market was crashing, only to just on October 20th reevaluate the entire premise and realize they'd made a mistake.
And so they were doing a lot of analysis. This is quite shocking. It turns out, if you actually do the analysis, and they did, these institutions did, they basically went in, eyes open, saying, let's run the numbers. What do I need to own in crypto to capture 90% of the alpha, the volatility? Turns out all you need is Bitcoin and Ethereum, and the rest of the poo-poo coins are worthless.
They had to do analysis on that? They had to, like, reevaluate? Really? Really? Just look at a price chart. Go on Twitter. Like, this is so stupid. Okay, but so the poo-poo coins have been no good. They've realized it's only Bitcoin and Ethereum, but you see, the turd is still coming. The punch bowl is not safe.
Of the alpha, the volatility. Turns out all you need is Bitcoin and Ethereum, and the rest of the poo-poo coins are worthless.
Yeah.
So they dropped 80, 90%. They never come back. Bitcoin got slaughtered because of a lot of deleveraging. Mm-hmm. Remember, we had all these treasury products that came out that had leverage on them. I'm still long this, but there's a new concern that is kind of floating around for 10% of the people out there.
Okay, a new concern, and it's floating around for 10% of the people. And Mr. Wonderful, he's pretty tapped in. Remember, he was friends with Sam, so he knows what's going on in the crypto world. He's tapped in. There's a brand new concern. You just heard about it. It landed in October, and this is really the issue. And until this is solved, Bitcoin is screwed.
They had leverage on them. I'm still long this, but there's a new concern that is kind of floating around for 10% of the people out there. Quantum. The idea that a quantum computer can break the chain.
Interesting.
And so until that gets resolved, there'll be some resistance at the institutional level to go past 3%.
I just wish they'd shut up because they don't even know what they're talking about. Break the chain. Break the chain. They don't even know what they're talking about, but they just spread stupid FUD all the time. It's so frustrating. So now compare and contrast. This is Bitwise's CIO, Matt Hougan, and he's going to talk about quantum, and he's going to talk about what some of you were saying in the booth, that we might be in this one for a while. And unfortunately, it is something I'm starting to come around to as well. And you can't really argue with what Matt lays out. So we started with our macro protein. We got our Bitcoin carbs with BIP 110. And now, I hate to tell you this, you're going to get your Bitcoin veggies here with Matt Hougan. So just chew up and swallow.
When we have talked more recently, I don't know if we've talked since the price plunge.
Right.
So I'm just curious, first of all, to get your take on what's been happening and what's happening with flows in your business, in your ETFs. Have we seen flows follow price?
Yeah, it's really interesting. There's sort of a tale of two markets. There's the original crypto investors who have been selling. I think that's one of the primary drivers of what's driving the market down. The institutional, or at least financial advisor market that Bitwise services has been buying. We had inflows last week. Even if you look at just the inflows of Bitcoin ETFs, yes, there have been some outflows since October, but very small. I actually think the ETF holders are the diamond hands, and it's been others who have been leading the downturn.
So that's really interesting, because I think one of the biggest questions I have during all of this is who is the natural buyer, so to speak, right? That the institutions who got into Bitcoin haven't necessarily wanted to step in there. What's your take on?
Well, yeah, I think that's the point. I think they're the eventual natural buyer, right? Institutions have most of the money, but most of crypto today is held by retail investors. So there's this transition from retail primary ownership to institutional primary ownership. The reason you're not seeing the institutions sell is it's been risky professionally to buy Bitcoin. So you had to have very high conviction to buy those ETFs in the first 2 years. It's still outside of the norm. And for that reason, I think the existing holders will continue to hold in ETF land. I think institutions will help lead us out of this bear market, but it could take a while, right? It could be months, quarters, longer than that.
Let's take a step back, because you wrote an interesting piece recently where you kind of tried to grapple with the reason behind the pullback that we have seen. And you said it's not just one thing, it's a lot of things. So just succinctly highlight a couple of those reasons for us.
Yeah, crypto winners are never monocausal. They're always multiple factors. You had people selling ahead of the 4-year cycle. That's sort of a reflexive. They're selling because they think it will go down.
They're never monocausal. Never a word I would have used myself, but it exactly describes how I think about this. It's never one thing. It's never one thing that brings it all down, which means it's never one thing that brings it all up.
Factors. You had people selling ahead of the 4-year cycle. That's sort of a reflexive. They're selling because they think it will go down, therefore it goes down.
Self-fulfilling prophecy.
That's right, but it's true. You had people worried that Kevin Warsh will shrink the balance sheet. You had people worried about quantum risk in the market. You had a macro sell-off in software names. You add all those together and it's too much weight. The market just falls over the course of time. Those are now well known in the market. We're starting to see some positive news come in, but the same thing is true on the reverse.
Now, before he gets there, what I like about this is really everything we've been talking about for the last few weeks. I should have just taken the last few weeks off and played this clip. But now what Matt does is he brings it to how we go back up in price. And this is where I say we're eating our veggies.
Those are now well known in the market. We're starting to see some positive news come in, but the same thing is true on the reverse. It's not going to be one thing that turns this market around. It's going to be a slow accumulation of multiple pieces of good news. When that eventually overwhelms that bad news, we'll return up to all-time highs.
So you don't think there's going to be like a catalyst?
This is not a V-shaped bottom. No, there were multiple factors that drove us down. There will be multiple factors that drive us back up. Progress on quantum, maybe Kevin Warsh cutting rates more than people expect, maybe these institutional flows coming back, the rise of agentic finance. It was multiple things coming down. It will take multiple things to come back up, but we will see those things over time.
Now,
the rise of agentic finance. Yeah, maybe. I don't know. What I see happening seems like, God, I have an agent set up with an Alby Hub sub wallet. Little budget, it works great. It's amazing. Callie has put out an eCashew skill for OpenClaw agents, so it absolutely can be done. But I'll tell you what I'm seeing more of a trend is the poo-poo coins, as Mr. Wonderful put it. A lot of base. Today I saw some stuff around Tether. So and they're integrating base and these payments in at like service levels. So people have created LLM proxy routers to route your agent's request to the most price-efficient LLM. And the agent auto-pays on the base chain, on Coinbase's thing. So I don't know if Bitcoin will be the go-to payment system for all agents. I think for some, obviously, especially ones that are doing really important transactions, but there isn't a Bitcoin marketing department that's going to go put out SDKs and MCP servers, right? There are individuals like Callie and others that are doing it, but there's no Coinbase marketing department behind it. So I do wonder about that. I'd be curious to know what you think about agents and, using Bitcoin. I would love to hear your feedback if this is something you've thought about.
Multiple things coming down. It'll take multiple things to come back up, but we will see those things over time.
Now, one of the other themes I've been talking to a lot of people about today is TradFi meets DeFi, right? That institutions coming into the market. I mean, Bitwise is kind of an example of that, right? The ETFs, which is a more institutional product applied on top of something that is very non-traditional. With that has come all kinds of new products, right? You've had options, which are newish still to the market. You've got leverage of all kinds. Is that a good thing or a bad thing? What are the risks of layering that on top?
Yeah, look, mostly it's strictly good. Bitcoin is more valuable the more liquid it is. It is more useful in a macro perspective. It is more useful in a global perspective. You need all those derivatives to pile up to add liquidity. It does introduce a new risk, which is now Bitcoin is more integrated into other macro hedge funds. Right. It's more integrated into the macro economy. There's certain thoughts that part of the sharp sell-off last week was due to non-crypto hedge funds unwinding crypto as part of a more complex trade. So we're now in the game. The game is complex. We're not our own corner of the market. That introduces some negatives, but mostly it's positive.
Yeah, it does. And one of those negatives, as I've been saying on the show, is we are a bit in a holding pattern until the damn Clarity Act passes, which I hate, as you know. And here we are. Another week goes by where we have to do a little bit of a clarity update. It is moving. Brian Armstrong is in D.C. right now, and he's buddied up with Senator Bernie Moreno from Ohio. And they've sat down, and they kind of let it slip when we might actually see clarity pass.
Part of this equation.
Wait, can we just explain this? Like why people should care about this? What the whole yield rewards on stablecoins thing is about?
Oh, yeah, I included this, too, because I want to hear your thoughts on this.
Well, unless you own a bank, you probably shouldn't care. Because if you're an American consumer, what it means is that the cash that you hold, you're going to have competition to pay you more interest. So you're going to be able to get more money for the money that you have in your wallet or the money that you have in some sort of account. So this is very, very good for working Americans, because ultimately this is about giving Americans more rewards for being able to have cash on reserve, being able to get paid quicker, being able to transact faster.
All right, do you think, 'cause you guys haven't answered this, and I asked last week too, do you think people will leave their bank account for 3% rewards in stablecoins? I mean, that doesn't even beat actual inflation for the goods you actually buy in your day-to-day life. I guess it's better than nothing. But is this really a thing? Are people going to go to these quasi-casinos to put their savings account on there to get 3% back? There's other products in the market that are better and produce better yields with established financial institutions. I'm genuinely not clear. I mean, maybe kids.
Democratize the financial systems. But we're going to get this bill across the finish line. But I would say...
When?
Hopefully by April.
I was going to say, because if you don't by the midterms and then the House goes Democrat, then what happens to it?
Well, the House isn't going to go Democrat, neither is the Senate. People say, well, the election were today. The election is not today. We're going to win because, look, at the end of the day...
All right, he goes into campaign robot mode. But your buddy, Scotty B., the Treasury Secretary, he said something that caught my attention. He said that passing the Clarity Act would bring comfort to the market.
The overall crypto community. So, in a time when we are having one of these historically volatile sell-offs, I think some clarity on the Clarity Bill would give great comfort to the market, and we could move forward from there. So it's very important to get this done. And I think if the Democrats were to take the House, which is far from my best case, then the prospects of getting a deal done will just fall apart. I mean, look what the Democrats did to crypto under the Biden administration. It was almost an extinction event, and President Trump has worked to make the U.S. the digital asset capital of the world. There's a lot of innovation that goes on adjacent to crypto in the blockchain, in DeFi. So I think it's important to get this clarity bill done as soon as possible and on the president's desk this spring.
It's funny how, this spring, it's funny how they drop in DeFi there, like they have any idea, right? And honestly, guys, we want the market to be comfortable, right? Heaven forbid, the market was uncomfortable. All right, final clip of the week time. And I'm playing a classic because it's so relevant today. This clip shows us no matter how educated somebody is, no matter how deep they are in the financial system, it can be extremely difficult for them to understand Bitcoin. In fact, it can be an impairment to understanding Bitcoin. And it takes these folks a really long time to wrap their heads around it. And that's why some people that seem like they're the smartest financial people still don't get it. And I love this clip because this is Professor Tad Smith, and he talks about his journey. And I think he's qualified to talk about this.
I didn't realize that if the average year the money printer goes, call it 8 to 10%, even in the Western countries, even in the OECD nations, and the average return on the S&P 500 is, call it 9-ish%, including dividends, maybe 9.7, maybe a little less, that it means that all of the work of the S&P 500, all of the value created there is actually the money printer. That to me was startling. I mean, to think about that, the fundamental notion that in a closed system or even an open system, when you're printing money at the rate of 8 to 10% a year, everything is losing value, and the things that appear to be gaining value are not gaining value. They're just keeping you even. So you can put all your money in the S&P 500 and you're not gaining any relative wealth at all. That's a startling insight. I mean, when you really think about the entire value of the S&P 500, on average, over a long period of time, not even a long period of time, is equivalent to the money printer. That's, to me, a shock. And it was a shock that said, oh my goodness, how do you think about creating wealth that is relatively greater in this economy? And you have to look hard. The other thing you can imagine is I could tell you about Sharpe ratios and diversification. I could tell you all these different things. And, you know, it's interesting. You can take a concept like diversification of risk, and at a top level, it can be a very powerful and useful tool. But if you are so focused on the mechanistic aspect of that, you can step back and miss the forest, which is in a highly diversified portfolio, it's unbelievably hard to pick up relative amounts of wealth. It is. Diversifying your portfolio, however you do it, is by and large going to reduce your incremental gain in wealth, irrespective of the Sharpe ratio. It's concentration of capital in specific bets that outperform the money printer where you actually create wealth. That was a shock to me. I just didn't get it. I didn't understand it. Even though I taught finance for 20 plus years, I'm still a professor at NYU Stern, at Stern Business School. I've taught strategy and finance for technology, media, and entertainment companies. I'm on a 2-year hiatus, but I'll be presumably going back in the spring. For 25 years, I have almost, actually more than 1,000 former students. And I still didn't get it until I'm age 58. That's the Bitcoin journey.
All right, I am wrapping up at block height 937,286. Bitcoin's price to US dollars right now, 66,321 Bitcoin. All right. That makes our sats per dollar 1,508. 1,500 sats to $1. We are down 47.4% from our all-time high, which was $126,180 135 days ago, October 6th, 2025. Our difficulty retarget date, February 19th. An estimated upward adjustment of 14.4%, Oh, we should have got our mining pool going, boys. It's getting up there. That's a big jump. That might change a little bit. I don't know. That's a big one. Well, I'm looking at the total nodes. Everything's looking really good. I'd love to see more nodes, but we've gone up a tick. 25,207 Bitcoin nodes out there. The transaction fees are crazy right now. Just a big, huge, expensive one sat for a V-Byte. One sat. All across the board. For quick, low, fast, high. Jeez, it's bad. I mean, gosh, clearly the spam's a real issue. I think the blockchain is doing just fine. Well, if you made it this far, links at thisweekinbitcoin.show. This was episode 93. The whole back catalog is there. Maybe you can go find the last time I played that clip of the week. I hope you got what you needed from today's episode. I try to focus on the signal as much as possible, even though it gets a little tough when things are a little existential. That is my job, and I try to get you the information, and I will have great links for you in the show notes, too. Let me know how you think I did on that with a boost as well. And I'd love to see you in Pasadena around March 5th to the 9th-ish. We'll be at Planet Nix and at Scale, the Southern California Linux Expo. Biggest Linux event in the North America area, so we'd love to see you there. Meetup.com/Jupiter Broadcasting is where I have the details. Even if you can't be at the event, I'd love to see you at the meetup if you're in the area, because I just love talking Bitcoin. All right, I'm going to leave you with a track. Of course, if you boost during this track, then 95% of the sats will go to the artist. And this week, it's Radio Brigade by Mellow Cassette.
On you. I'm not saying that it's fair, I'm just saying where there's smoke there's probably ashes too. My mind was on the fight, I followed you all night. God let me make this right, God let me make this better off instead. The light is thought you tread, yeah it's my fault I fed into a heart worth breaking. Imitation powder keg with fuse to spare. You can light it all you want, but the Radio Brigade reclaims her rightful air.